that I was making around this area right here on the 10-year yield. So again, Wyckoff methodology is very contrarian, so you always see the signs, the emergent signs of the change of behavior, and then you look for the confirmation of that. So what do we see? We see the shortening of the upward thrust, meaning that all of these meaningful rallies are starting to diminish in terms of the progression to the upside. And then you start seeing confirmation as this bar actually told us, like, that's it, this is the top. Then the next bar is confirming, then the next move is confirming as well. So we said the change of behavior that potentially could lead us into some kind of trading range. Now, today was very interesting because we just had the release of the Fed meetings, from the last meeting. And I would say that it's almost as if the Fed is a little bit living in the past. And obviously that their data will improve. We don't want to say that, okay, everything is geared just towards the solution of the inflation problem. We're definitely seeing some deterioration in growth. So that has to be mitigated as well. So the idea here that Bruce and I both have been kind of like introducing to our students was that maybe there will be increases in the Fed rate, but they are not going to be as aggressive. Maybe like 225 basis points. Now today they're saying like, no, we're going to go 50. And not only once, we could do twice, or maybe even 3 times. And I think that the chart usually is smarter than the Fed, just because the Fed is somewhere behind. And that's why it makes a lot of sense. And by the way, we're a little bit lower. We're somewhere here right now we're at 275 today. This is a trading range where we are. So we could go up and up thrust. We could go down. We could up thrust again. We could go down and have some kind of much larger structure. On the much longer term perspective, there is a trading range of its own, and every high and low is being respected. So we just get out, and in front of us, kind of like this resistance cluster with the high of 4%. I think 4% or slightly above it would be something of the highest point that we could go to. And then after that, I think that we are going back into the trading range. That's kind of like a hypothesis that I have and that we have. And with that, Bruce, your quick thoughts on yield?
Oh, no, that was great. And we've actually, I don't know if you put that point figure chart in there. Yeah, here it is on the left. And so this is the same data. This is the 10-year yield. And so I'm doing point figure on yield. Okay, so you can do that. And actually it works scary well. And so you can see that distribution count on the left. And this is just a 1-box reversal chart. And I call it a swing trading chart. But the time frame, look, it goes all the way back to 2016. Look how well this distribution count picked up the falling interest rates into the 2020 low, 2021 low, and then an accumulation structure. And so we've been using this chart for a long time, actually, and I just updated it here so you could see it, but see what happened subsequently. But this, here we have a little hinge, and then out we come in late 2021 out of this base in yields, and a sharp rally goes up. It hit a high of 312, and I had a count range that ultimately went 260 to 340, and maybe we can still get up to that 340 level the way that Ramon described it, but we are definitely in the area of this fulfilling that count. And so here we are, and we just need to see some kind of a new structure, reaccumulation structure or distribution. But you can see that's exactly what yields will do, is they'll create another cause for another move, and we have just fulfilled that move.